Hello everyone. Welcome to Brilliant Bankers. In today's session, we'll be discussing about the Treasury and Asset Liability Management, wherein we will discuss about the role of the Treasury in the Asset Liability Management and how it manages the ALM risks and the importance of an integrated risk management policy in a bank. So, what is an ALM or a Asset Liability Management? It is a strategic management process that helps financial institutions align their assets and liabilities to optimize risk, profitability, and liquidity. So, what is it? It is like a financial balancing act for the banks and the financial institutions. It's about making sure that the right mix of investments, that is, the assets and the funding sources, the liabilities, to manage risks, ensuring the profitability and stay stable even when the economic conditions change. So, what are the parts of a asset liability management? They are the assets, the liabilities, and the risk management tools. Assets. In the case of a bank's asset as a thing it owns to make money, like loans given to people for buying homes, cars, and the investments in the bonds and securities, the personal loan, and all these kinds. What are the liabilities for a bank? They are the money that the bank owes to others, such as deposits from the customers or the monies borrowed from the other banks. So, what is the risk in this? It is the interest rate risk. If the interest rates changes, which they do often, it affects how much the bank earns on loans and how much it pays on the deposits. The ALM helps the bank to manage this interest rate risk. It also helps in the liquidity risk. Let's say a lot of people suddenly want to withdraw their money from the bank. In that case, the ALM helps the banks to ensure it has enough cash or the liquid assets to meet these demands without causing a financial crisis for the bank. And what is the process? The process for ALM is it is the identification of risk, that is the access the interest rate risk, the liquidity risk, and the market risk exposures of the bank. Setting objectives for the process of the ALM, like defining the risk tolerance, profitability goals, and the liquidity requirements of the bank. Strategic formulation, that is, develop the strategies to optimize the bank's sorry, develop the strategies to optimize the balance between the assets and liabilities by implementing or executing the ALM strategies while monitoring market conditions and regularly reviewing and reporting on the performance of the assets and liabilities against the set objectives of the ALM. So, what are the objectives for the ALM? It is risk mitigation, that is, identify and manage the interest rate risk, liquidity risk, and the market risk to ensure the financial stability of a bank or a treasury. To increase the profitability of a institution or a financial institution, that is by maximizing returns on the assets while controlling the cost of liabilities and aiming for sustained profitability. And also, liquidity management is a main objective in the case of ALM, that is to ensure the availability of funds to meet obligations while maintaining a balance between the short term and the long term assets. So, what is the role of a treasury in ALM? The role of a treasury is a quite big or a significant role. It regulates the ALM practices of the bank in India. The ALM guidelines are being provided and are crucial for maintaining the financial stability, managing risks, and ensuring that banks operate prudently in the same. So, some of the main role of a treasury in ALM, which is as directed by the RBI, are the guidance and the regulation. The treasury department within a bank is responsible for implementing and adhering to the ALM guidelines that are provided by the RBI, which includes understanding and interpreting the regulatory requirements. By ALM policy formulation, the treasury team, guided by the RBI regulations, formulates the bank's ALM policy. This involves Setting objectives, defining tolerance, that is the risk tolerance, and establishing the strategies to manage assets and liabilities effectively. The risk management, the Treasury plays a pivotal role in identifying, measuring, and managing various risks, such as the interest rate risk, liquidity risk, and the market risks, as per the RBI guidelines. They also go the main one of the main role of the Treasury is the compliance. The Treasury Department ensures that the banks ALM practices comply with the RBI's regulatory framework, which involves the regular reporting and submission of the ALM related data to the RBI, and also by liquidity management. The Treasury manages liquidity, ensuring that the bank has enough liquid assets to meet short term obligations. It aligns with the RBI guidelines to maintain a healthy liquidity position of the financial institution and the bank. Coming to the interest rate risk management, the Treasury actively manages interest rate risk by structuring the assets and liabilities in line with the RBI guidelines. This includes monitoring the bank's impact on the interest rate changes on the net interest income by stress testing of the bank. This is by stress testing to assess the bank's resilience under the adverse scenarios. This helps in identifying the vulnerabilities and developing the contingency plans if required for the financial institution, and also by reporting to the RBI. The Treasury is responsible for preparing and submitting ALM reports to the RBI as per the prescribed formats and timelines. This ensures transparency and the regulatory compliance of the rules and regulations that are issued by the RBI for the financial institutions and the bank. Strategic decision support. The Treasury provides strategic inputs to senior management based on the ALM considerations. It plays a key role in decision making related to the assets and liability composition and the overall risk management. In a total essence, the Treasury with a bank is the main and the frontline executor of the RBI's ALM guidelines. It interprets and implements these guidelines to ensure that the bank operates within a robust risk management framework, contributing to the financial stability and regulatory compliances. The symbiotic relationship between the RBI's regulatory oversight and the Treasury's active management is critical for the overall health of the banking system in India. So, how are the derivatives being used in the asset liability management? Derivative instruments are useful in managing the liquidity and interest rate risks, as also in structuring new products which help overcome market risk to a large extent. They replicate the market movements and hence can be used to counter the risk inherent to the regular transactions. For example, if you are buying a stock which is highly sensitive to market movement, we can sell the index futures as an hedge against the fall of the stock prices. This advantage in derivatives is the requirement of capital is very small and largely there is no deployment of funds except in the case of the exchange traded instruments. Derivatives can be used to hedge high value individual transactions or aggregate risk as reflected in the asset liability management mismatches. In the later case, a dynamic management of hedge is necessary as the composition of assets and liabilities is always changing in the bank. So some of the illustrations how this derivative can be used to manage ALM risk are. Let's assume that the bank is funding a medium term loan of 3 years with deposits having an average maturity of 3 months. So the short term deposit or borrowing in interbank market is very much cheaper than that of a 3-year deposit. Hence, many banks have resorted to funding their regular loans for short term resources in order to increase their spreads. This is how, or there is a liquidity risk as a bank needs to pay back the short term deposits much earlier to the repayment of the 3-year loan. This is also a interest rate risk as the deposits will be repriced 12 times during the lifespan of the 3-year loan, because the deposits are for 3 months and the loan is for a period of 3 years. And each and every 3 months, the deposit is being renewed. So it is being repriced 12 times during the lifetime of the loan. The interest rate on the deposit is always akin to the floating rate, as the bank has to pay the market rate of risk whenever the deposit is renewed again. Market rates can be the benchmark to risk free interest rates. For example, say the 91 days T bill in the same case. The banks may therefore swap the 3 months interest rate into a fixed rate for 3 years, so that the interest cost is also fixed and the spread over the loan is protected. Coming to treasury arbitrages, it's foreign currencies. The bank may borrow, say, for 6 months in USD and lend the equivalent rupee fund in the domestic market. The USD funds cost around 3%, while the rupee loans yield, say, 6.5% for the same period. The spread is a clear 3.5% profit for the bank. The treasury takes care of the exchange risk by paying a forward premium of 1.5%. Even then, the bank earns almost 2% without any exchange risk. So, this forward premium is the cost of hedge against the currency risk. Treasury can also thus supplement domestic liquidity and also ensure a positive spread for the banks. The Treasury enables the banks in structuring new products, which helps reduce the mismatches in the balance sheet also. By floating rate risks and the floating rate loans, where the interest rates are linked to the benchmark rate, have become fairly popular. In the securities market, we have the government securities where the interest rate is linked to the rate of inflation. So protection against the rate rise is inbuilt in the index linked bonds. Corporate debt paper is also issued with the call and put options to suit the risk appetite of the individual investors. The embedded options are also useful to improve the liquidity in the case of the investment. So it is assumed that the bank's projects are priced rationally or rationally. If the interest rates on deposits and loans are based on the benchmark rates, interest rate swaps may not be really helpful in the case of the bank or the treasury. Even when the interest rates are fairly aligned, the product prices may not exactly move in the same line. So the treasury may not be able to provide a perfect hedge, wherein ALM uses a broad time bands. Hence, even after using appropriate hedges, the market risk may not be completely mitigated. The residual risk, which is also called as a basis risk, the residual risk, which is also called as a basis risk. There are embedded options in certain bank products. For instance, a fixed deposit or a term loan can be prepaid, and such prepayment escapes the ALM analysis and cannot be fully hedged in any condition or the cases. So, what is a credit risk and what are the credit derivatives? Credit risk is mostly concerned with the, in the case of treasury, is mostly concerned with that of the market risk. So, credit risk is in treasury business is only with respect to counterparty dealings contained by exposure limits and the risk management norms. In normal course, the treasury operations are untouched by the credit risk present in banks' lending businesses. However, there are two ways in which the treasury may get intertwined with the banking operations in the credit area. Firstly, there are several treasury products, or more correctly, they are called the debt market products, such as the commercial papers, the bonds, the commercial bonds, which are the credit substitutes for other things. Highly rated companies prefer issue of debt paper to the bank credit, as cost of credit is relatively lower in the case of the debt market, where in addition to banks, there are other investors who may invest in debt instruments. This, instead of lending to a company, the bank may also prefer to invest in the corporate bonds through the treasury. While credit risk is in a loan and bond is similar, unlike a loan, bond is tradable and hence is a more liquid asset. The bank has an easy exit in that the bond can be sold at a discount if credit status of the issuers deteriorates. while a loan is normally with a fixed rate of interest or interest linked to the base rate of the MCLRs of the bank. The bond is always priced in the market on the basis of the credit quality and the interest rate movements. Hence, the bond may be marked to market as frequently as required for assessing the potential gain or loss. Therefore, the non-SLR investment portfolio of a treasury, which supplements bank's credit portfolio, is therefore more flexible and ideal for the ALM point of view. Coming to the second point, that securitization. There are new products which convert credit into tradable treasury assets. This is what we call as a securitization, whereby credit receivables of the bank can be converted into units of bonds that can be traded in the market. For instance, the mortgage loans of the bank can be securitized and issued in the form of the PTCs through a special purpose vehicle which has been created for the same purpose, which amounts to a sale of the bank's loan assets. Therefore, securitization infuses liquidity into the issuing bank and frees the capital blocked in such assets for fresh lending, that is by using the SURFACE process. What is a credit derivative? It has come into the market only since the last 10 years. Credit derivatives segregate the credit risk from the loan or investment assets. The instruments known as credit default swap or the credit link certificate transfer the credit risk from the owner of the asset to another person who is in a position to absorb the credit risk for a fee. There is a production buyer, say a bank, that is, a bank is ready to take over the credit, or there is a production seller who may be another bank of an investor and a reference asset, which may be a large corporate bond or any other trade debt obligations. So credit derivatives helps the issuer to diversify the credit risk and use the capital more efficiently. The credit derivative is a transferable instrument, wherein through the market for credit derivatives is very liquid. The credit derivative products are still emerging and various covenants related to a transaction are incorporated in the master agreement for the credit derivatives. So what is transfer pricing? It is an integral function of the asset liability management and is in the domain of the bank's treasury. So transfer pricing refers to fixing the cost of resources and returns on assets of the bank in a rational manner. The treasury notionally buys and sells the deposits and loans of the bank, and the price at which the treasury buys and sells forms the basis for assessing the profitability of the banking activity. The treasury determines the buy and sell prices on the basis of the market rates of interest, the cost of hedging market risk, and the cost of maintaining the reserves asset of the bank. For example, the banking department may procure a deposit at 7%, but the treasury buys the deposit at a market cost after adjusting to a hedging and liquidity, say at 6%. The difference being the cost exclusively borne by the banking department. Similarly, the bank may lend at 10% and sell the loan to treasury at a transfer cost, say 7%. In this case, the balance being the risk premium earned by the bank section or the banking section. The price vary according to the tenor of the loan and the deposit. There are, of course, different ways of arriving at a transfer pricing, and the bank has to formulate a conscious policy in this regard. And coming to the last point, the policy environment. The asset and liability management will be effective only if there is a strong policy foundation. Though in general, we describe it as an ALM policy. The policy should aim at an aggregated risk of the bank and should achieve coordination between the different departments of the bank and treasury. So therefore, an integrated risk management policy bearing upon the market risk of the bank and the interest rate and the credit risk should ideally have some of the following components. That is the ALM policy, which prescribes the composition of the Asset Liability Management Committee, the ALCO, and operations aspects of the ALM, which includes risk measures, monitoring of risk, the risk neutralization, the product pricing, management information systems, and more importantly, how to improve and to maintain the existing NIM. What is a liquidity policy? It prescribes the minimum liquidity to be maintained, funding to reserve assets, limits on the exposure of money market, and the contingent funding, interbank committed credit lines, etc. The derivatives policies prescribes norms for use of derivatives, capital allocation, restrictions on the derivative trading, valuation norms, and the exposure limits of the bank and the treasury. The risk policy for forex and treasury, the composite risk policy prescribes norms for merchant and the trading positions, securities trading, exposure limits, the limits on the intraday and the overnight positions, also the stop loss limits and the periodical valuations of the trading positions, etc. What is a transfer pricing policy? It prescribes the methodology. It spreads to the retained by the treasury, the segregation of administrative costs and hedging costs, allocation of the cost to branches or other departments of the banks, etc. The policies quoted exclude the risk management policies for credit risk and the operation risk, which are not in purview of the Asset Liability Management Committee. So, essential requirements of all these policies are the policies are to be approved by the highest level, either by the board or by the board committee. The policy should also comply with the external regulations of the RBI and all other regulatory bodies such as the SEBI. And also, the policy should only comply with the current market practices and the code of conduct as evolved, like the FIMDA and the FEDI. So, with that, we come to the end of our module C in the bank financial management section. If you have any questions on the subject, please feel free to post them in the comment section. Your feedback is very valuable to us. Please do like, share, and subscribe our channel, The Brilliant Bankers.